Okay, so, you see those economic headlines, right? And
Hmm.
maybe the stock market's looking pretty good, but, you know, underneath all that,
Right.
things could be shifting
Absolutely.
in a big way.
Yeah.
And so in this deep dive, we're going to take a look at something that's super fascinating and frankly really important.
Yeah.
And that is how a potential decline in asset markets.
Okay.
So we're talking stocks, we're talking housing,
Right.
how those things could actually have a really direct impact on something that affects you every day,
Sure.
your real interest rates.
Okay. So we're going to be looking at the Gloom, Boom, and Doom report from August 2024.
Okay.
And it raises three big questions about the future. And for this deep dive,
Yeah.
we're going to be focusing on where long-term US Treasury yields might be headed
All right.
and what that could mean for the economy and, specifically for you.
All right. So back in the summer of 2024, the author of this report was already saying
Yeah.
pretty definitively that the U.S. economy was actually in a recession.
Oh.
And he traced that back to um, late 2023, early 2024.
Okay.
And one of the things he pointed to was a real decline in real disposable income.
Yeah.
And that's the money you have left after inflation
Right.
eats into your income.
Right.
And he also pointed to this idea of a restaurant apocalypse,
Oh, wow.
where even big players like Chipotle were actually feeling a squeeze in demand.
Interesting.
And he was even looking at Chipotle's stock chart,
Right.
noted that it had broken down,
Okay.
but he thought there might be a short-term bounce.
Interesting.
So it wasn't just a feeling, he was looking at data.
So this idea about consumers pulling back,
Yes.
that actually gets expanded on quite a bit in the report.
Yeah.
Because it wasn't just fast food.
Right.
The author highlighted that there were struggles in the luxury goods sector as well.
Okay.
So you're talking brands like Adidas, Puma, Nike.
Yeah.
And that drop in Nike stock price was specifically mentioned.
Right.
So this suggests that even the desire for those higher end discretionary items was starting to wane. So it's not just about people trading down.
Right.
It's about people just spending less overall.
Yeah. And it wasn't just clothes and sneakers either.
Right.
Um, the report goes on to list a whole bunch more companies that were seeing their stocks under pressure.
Okay.
Walgreens, Kua Sushi, Levi Strauss, Estee Lauder,
Wow.
Burberry,
Okay.
even Barry Callebaut.
No.
That's the Swiss chocolate giant.
Okay. Interesting.
Swatch, Hugo Boss, American Airlines.
Okay.
And the details around Swatch are really telling
Okay.
because they said that their sales and profits had taken a significant hit.
Yeah.
And they pointed specifically to a slowdown in demand for luxury goods out of China.
Oh.
And they even had to cut production.
Yeah.
So what's really interesting for you here is that
Mhm.
this starts to paint the picture
Yes.
of a broader cooling of consumer appetite.
Yeah. And what's interesting is that, there are analysts who are saying, well, this company missed its earnings target because of this, and this company missed its earnings target because of that. But what the report does that's really smart is it takes all of these examples and says,
Right.
wait a minute, there's this more fundamental issue here.
Yeah.
And that is none of people are buying stuff.
Right.
So this widespread pullback that's affecting everything from your quick lunch to your high-end watches.
Yeah.
This isn't just about company profits.
Right.
This is a potential early warning sign that the underlying economic strength that you might be seeing in some of those headline numbers
Yes.
could be a little more fragile than it appears.
Right.
And that's what kind of sets the stage for this conversation that we're going to have about these asset market dynamics.
Right.
That could have a direct impact on your real returns.
Right. And then it moves on to the airline industry,
Okay.
which is another sector where you think, oh, things must be booming there.
Right.
You hear about record passenger numbers.
Right.
Jet fuel prices come down.
Yeah.
But even there, the picture wasn't so rosy.
Okay.
For example, Delta
Yeah.
recorded record revenue,
Mm-hmm.
but they actually saw their profit shrink.
Okay.
And they lowered their financial outlook for the future.
Wow.
And the idea was that airlines had maybe overestimated demand
Okay.
and added too much capacity,
Right.
and that put downward pressure on ticket prices.
Yeah.
And it's that classic economic problem of too much supply
Right.
and potentially weakening demand.
Yeah. So it's not really a great situation,
Not so great.
especially if you're an investor.
And then they quote this article from Barron's,
Mm-hmm.
and they call the airline industry a great black hole for investors,
Oh, wow.
which is not a very flattering description.
Not great.
And the analyst that they were quoting in the article had actually lowered his profit estimates for the entire sector.
Wow. Okay.
And he specifically noted disappointing revenue from Southwest and American.
So even with this seemingly positive backdrop of all these passengers,
Yeah.
the financial reality for these companies was becoming less attractive.
Yeah, and speaking of Southwest, they had their own unique set of challenges.
Yeah.
They had those ongoing delays with the Boeing 737 MX aircraft.
Right.
They had some pretty significant computer system failures.
Okay.
And even a situation where they had too many staff in certain areas.
Interesting.
And this caught the eye of activist investor Elliott Management.
Okay.
And they took a big stake in the company.
Okay.
And they're now pushing for leadership changes.
Interesting.
They view it as a turnaround opportunity.
So there's some potential there, maybe.
Maybe.
Yeah.
So it's a good reminder that even within a sector that's facing some headwinds,
Right.
you can have very specific company-level issues and potential for change.
Right. So what's interesting is the report's starting to weave together these seemingly unrelated pieces of information.
Yeah.
From struggling retailers to airlines facing profit pressures and company-specific challenges
Yeah.
to create this broader narrative of underlying economic softness.
Right.
Even when some of those headline numbers might look okay.
Right.
And then they transition to looking at some really unusual signals that were coming from the financial markets.
Yeah.
Back in July 2024.
Exactly. And one of the key market anomalies they highlighted was the performance of the Dow Transportation Average.
Okay.
And this is where it gets really interesting.
Okay.
Because this index, which includes players like airlines, truckers, freight companies like FedEx and railroads, that's often considered a pretty reliable indicator of the overall health of the economy. But back then, it was down for the year.
Okay.
And significantly below its peak from 2021.
So this is a key disconnect because it's suggesting that the actual movement of goods and people within the economy maybe wasn't as robust as some other more widely followed market indexes were implying.
Right. And then there was that really unusual day on July 11th, 2024.
Okay.
Where the small cap Russell 2000 index surged quite a bit, while the S&P 500 and NASDAQ 100, which represent larger companies, actually declined.
Okay.
And they point out that there was only one similar event during that deep 2008-2009 bear market.
Oh, wow.
And what's even more interesting is that the Russell 2000 ended up outperforming the S&P 500 for a significant period after that.
Interesting.
And then to add another layer of intrigue, the Russell 2000 actually broke out to new highs, while the S&P and NASDAQ did not.
So this divergence it's really raising some important questions about what different parts of the market are trying to tell us.
Right. So you might look at that Russell 2000 breakout and think, hey, small companies leading the charge, that's got to be a positive sign for the economy.
Right.
But the report argues that that was probably a misleading signal.
Oh, okay.
Kind of a head fake, if you will. And they use that to launch into even further evidence that there was this underlying economic weakness.
All right. So it's a good reminder that not all market movements are created equal.
Right.
And sometimes you got to dig a little deeper to understand what's really going on.
Absolutely. And then we get to another really critical indicator,
Yeah.
which is consumer confidence.
Right.
And the University of Michigan Consumer Confidence Index in July 2024 had fallen to its lowest point since November 2023.
Okay.
And it was significantly below where it was before the pandemic.
Wow.
And what was really concerning was that expectations for job growth were declining. And there was real reluctance among consumers to make big purchases.
Okay.
Especially big ticket items like houses and vehicles.
Right.
In fact, the intention to buy a home had fallen to its lowest point since they started tracking that data all the way back in 1978.
It's a long time.
That's a long time.
Yeah.
You know, it's a pretty powerful signal about how people were feeling about the future.
Right.
And this really underscores that while, you know, the official inflation numbers might have been showing some signs of moderation, nearly half of all consumers were still complaining about how those high prices were eating away at their living standards.
Okay.
And this was hitting lower and middle income households particularly hard because they tend to have less in savings and weaker prospects for income growth.
Right.
So what they're saying is that these segments of the population were experiencing their own economic downturn.
Interesting.
Even if it wasn't being officially labeled as a recession for everyone.
So a kind of a tale of two economies in a way.
Yeah.
Yeah. So this aligns with what economist David Rosenberg was saying.
Okay.
Because he was predicting a coming deflationary recession And he emphasized that people's expectations for their future real income were at historically low levels.
Okay.
And this was fueling what he called consumer revolt, not just against the high rate of inflation that we'd seen, but against the persistently elevated prices themselves.
Yeah.
And he pointed to the fact that the cyclical CPI, which looks at more economically sensitive prices, had actually been deflating for 4 months in a row at that point.
Okay, and that's an important distinction.
It is, because different measures of inflation can tell different stories.
Right, and this brings up this debate about should the Fed be cutting interest rates?
Yeah, that's the big question.
Because Rosenberg clearly thought so, given the deflating cyclical CPI. But the report we're looking at expresses some skepticism.
Okay.
Both about how accurate those official inflation statistics were. And about the idea that just because some prices are declining, that automatically means a lower overall cost of living.
Yeah, for sure. And they use these very relatable examples of like chocolate and coffee.
Ooh.
Pointing out that even if some prices are coming down, you might still be paying more for those little daily indulgences. You know, which I can definitely relate to.
And they point to this really interesting idea of recession amid accelerating inflation.
Wow.
Which was actually the title of a previous report that they had written. So it's this kind of tricky, counterintuitive situation we could be in. Where you've got this economic slowdown that might be more significant than a lot of people are anticipating. Even if we don't see a complete return to very low inflation.
So it's important to keep that in mind when you're thinking about your finances.
Absolutely. And then they talk about the Bloomberg Economic Surprise Index.
Okay.
And think of this index as a way to track whether economic data is generally coming in better or worse than what economists are expecting.
Okay.
And what was notable was that this index had fallen pretty sharply over the previous 9 months, consistently showing that the economic data was disappointing expectations.
Interesting.
And this was happening at the same time that the S&P 500 was performing quite differently.
So you've got another disconnect there between what the data is saying and what the stock market is doing.
And that's always
yeah, that should raise a red flag.
A bit of a red flag.
Yeah, for sure.
So with all of this as background, all of these signs of economic weakness, these unusual market signals, this debate over inflation and interest rates, we come to the central question of this deep dive, which is how will asset prices likely react if the Fed starts to cut interest rates? Especially against this backdrop of a weakening economy.
So this is a really important question for anybody who has investments or is thinking about borrowing money.
Exactly. And they say that. Monetary inflation. Which is essentially when more money is put into the financial system. That tends to benefit people who own assets like stocks and real estate. But they're concerned that it distorts the free market and encourages excessive speculation.
And it brings us back to that point about Peter Bookwar's observation about lower income consumers struggling. And David Rosenberg's argument for lower interest rates.
And so they pose this question. Does it make sense to be cutting interest rates when stock prices and housing values are near all-time highs? Gold is trading at record levels. And cryptocurrencies are experiencing these big rallies. And they also cast some doubt on those low inflation figures, suggesting that the actual increase in the cost of living might be much higher.
They said maybe 5 to 10% annually.
And then they bring in some data from the Kabisi letter. And this is where it gets really interesting, especially for, the price you pay for food.
That's important to everyone.
And they said that Americans spent a record $17 trillion on food in 2023.
Wow.
Which is a $5 trillion increase.
Wow.
Since 2020.
So just a few years.
In just a few years. And a lot of that was driven by inflation. Fast food prices had jumped 31%. McDonald's prices had doubled in a decade.
Wow.
And 78% of U.S. consumers now view fast food as a luxury.
Interesting.
Rather than an everyday option.
So that's really changed perceptions.
And they emphasize that it's very unlikely that we'll see food prices return to those pre-2019 levels.
Because of all that increase in the money supply.
And then the issue of housing affordability is a big one.
For sure.
And they argue that just cutting interest rates is unlikely to fix those problems.
Yeah, because those problems were largely created by all the low interest rates and loose monetary policy we had in the past. But you can't just undo years of that with a few adjustments.
And they even say that lower rates might just reignite demand.
Right? They could just push prices up further in the short term without really addressing those fundamental issues of supply and affordability.
And then we have to talk about what they call the elephant in the room.
Okay.
Unsustainable fiscal deficits.
Yeah.
You know, the U.S. government was spending more than double the amount it was taking in through taxes. Back in May 2024.
Wow.
That's a worrying sign for you as a bondholder.
Yeah.
Because it suggests continued inflationary pressures.
Right, because the government's going to have to finance that debt.
Right, and related to those deficits, the U.S. government has a strong incentive to try to keep real interest rates low, if not negative, because those interest payments on that ballooning national debt
they're huge already.
Are already huge.
Right.
And they would only get bigger if interest rates were to rise.
So there's pressure to keep borrowing costs down.
Right.
Which could have implications for inflation and the value of your savings.
Right. And then they shift their focus a bit to look at potential vulnerabilities within the stock market itself. And they draw a contrast between the performance of the so-called Magnificent Seven tech giants.
Yeah, those are the big ones?
Yeah, and related companies which had seen these huge gains versus the more lackluster performance of value stocks, emerging markets, and some commodities. And what they're saying is that this underperformance of value stocks, which has been historically large, could be signaling a shift in market leadership.
So maybe those big tech stocks aren't going to be the place to be anymore.
Maybe not. And they also look at the historical long-term returns of different asset classes. Like, for instance, the S&P 500 has averaged about 10.3% nominal return over the past 100 years. But what's really striking is that back in 2023, investors were expecting way higher returns.
Yeah, they were expecting something like over 15% real returns.
Real returns. And so they're saying that that disconnect between historical performance and current expectations could point to a bubble.
Could be a sign that things are a little overheated.
And it does paint a picture of overinflated asset values in both the U.S. equity markets and the residential property markets.
Yeah, so those areas could be vulnerable to some deflation.
Yeah, and they point to what happened with meme stocks and what's been happening in parts of the commercial property market. Like that example they use of that office tower in Los Angeles. That lost a huge amount of its value in just 3 years. You know, that's a stark reminder.
Yeah, it shows how quickly things can change.
How quickly things can change and how it can really impact you.
Absolutely.
If you own property or if you're an investor.
For sure.
And they say that, you know, there's this debate about will we see these big declines in asset prices given what the Fed is doing right now? But they also say that it's already happened in some sectors. And the thing to remember is that at the peak of these booms, very few people are ever predicting.
Nobody wants to believe the party's over.
They always think it's different this time.
This time is different.
So it's a good reminder.
It is.
And then they talk about how, you know, David Rosenberg believes in holding bonds. Because of this deflationary pressure that he's anticipating. But they offer a different perspective. They say that bonds would probably only really rally in a scenario where you had this massive asset deflation in equities and housing. And they say that given the size of these markets relative to the economy and the amount of debt outstanding, that would be a major economic crisis.
That would be a really bad situation for everybody.
And then they bring in the views of Bill Dudley, who's a former president of the Federal Reserve Bank of New York. And he's concerned about these rising fiscal deficits and the increasing amount of government borrowing, which he thinks will probably be concentrated in short-term Treasury bills. And he's worried about a vicious cycle.
Oh, no.
Where that increasing government debt leads to higher interest rates, which then puts even more pressure on the Fed to devalue that debt through inflation.
So it's like this self-perpetuating problem.
And he also points out that we don't really know when bond investors, who they sometimes call bond vigilantes,
might
suddenly decide that they've had enough.
Right.
and react negatively.
Yeah, so a lot of uncertainty there.
Yeah, for sure.
So these are some negative points for long-term bond prices.
Yeah.
And they do note that the 30-year Treasury Total Return Index has been showing this topping pattern.
Okay.
That suggests that the strong returns in those bonds might be over.
Okay.
And he also suggested that a potential second Trump administration could lead to much higher levels of inflation.
Yeah, maybe even Erdogan-ish levels of inflation.
Yeah, in a decade.
And that's something that bond investors would definitely have to think about.
Yeah, for sure. So this whole concept of bond vigilantes from back in the 80s and 90s is relevant here because these were basically investors who would sell their bonds like crazy at the first sign of rising inflation.
Right.
Which would then push up interest rates and keep real interest rates relatively high.
Right. And then they bring in this thing called the Gibson paradox.
Oh, okay. What?
Which is this historical observation that there's a positive correlation between interest rates and the price level.
Interesting.
And it suggests that maybe the relationship between interest rates and inflation isn't always so simple.
Yeah, it can be complex.
Yeah. And it might explain why those Fed rate hikes after 2022 didn't really have that immediate impact on inflation that some people expected.
Right.
And so all of this economic weakness, these asset prices, this debate over inflation and interest rates, it brings us back to this fundamental question.
Yeah.
Why would anyone want to hold US Treasuries in this environment?
That's a great question.
Right. And they point out that monetary policies and economic conditions don't really affect all sectors and asset prices evenly.
Right.
So they give the example of someone who owned commercial property in Los Angeles.
Okay.
Facing declining occupancy and rising costs.
Yeah.
Their experience of interest rates was probably very different than someone holding, shares in the Magnificent Seven.
Yeah, those high-flying tech stocks.
Yeah.
Yeah.
Right. And then they say, okay, what if we see a 10% decline in the U.S. stock market?
Okay.
And a 10% decline in residential property prices.
Okay.
Suddenly, the real interest rates on those assets are going to look a lot higher.
Right.
And they even suggest that this might already be happening if you look at indicators like the Taylor rule, which suggests that interest rates might still be too low relative to current economic conditions.
Interesting.
And then, of course, you've got the counter argument that there's all this liquidity in the market.
Right. Lots of money sloshing around.
Yeah. And that corporate profits are looking good. But they have some reservations about that.
Okay.
And they point out that even in periods of hyperinflation, you can still see those periods of tightening and big drops in asset prices.
So it's not unheard of.
It can happen.
Yeah.
Right? And they have this great anecdote about gold during the hyperinflation in Weimar, Germany.
Okay.
And how it was super volatile. There were some big sell-offs. But ultimately, it served as a lifeline.
Okay.
For people who held on to it.
Right.
Because their currency was becoming worthless.
Right.
So it's this idea that, sometimes it's the movements in the asset prices that actually determine whether monetary policy is tight or loose. So when those asset prices are going up really fast, you can actually have really negative real interest rates.
Yeah.
Because those assets are appreciating so quickly.
Right. Even if the nominal interests are low.
Right. And then when asset prices correct downwards, well, then that real interest rate suddenly feels a lot more burdensome.
Absolutely.
So it's this kind of...
Yeah, it's this complex interplay between the asset prices and the interest rates.
And they say that it's not just about nominal interest rate movements.
Right.
It's really the changes in those real interest rates that are driven by asset price declines.
Exactly. So that's a key takeaway.
Yeah. So with all of this, the report concludes by saying, we're holding U.S. Treasuries, but we're also holding a lot of precious metals and mining companies.
Interesting.
Because they're expecting that maybe we'll see higher Treasury yields at some point in the future, but not necessarily right away.
Okay.
And they also point out that, those FANG plus stocks and semiconductor companies with their sky-high valuations.
Yeah, everybody loves those.
Yeah. They could be vulnerable.
Right.
If we see even a temporary period of asset deflation.
They could come down quite a bit.
And while precious metals might also see some volatility, they think that they would hold their value relatively better during those times.
Interesting.
And then they circle back to those, as they put it, insane.
Right.
Long-term, real return expectations that a lot of investors seem to have.
Yeah, it does seem like people are expecting a lot.
And they think that the likely disappointment in achieving those returns
Yeah.
could lead to some interesting shifts in consumer behavior.
Okay.
And they've increased their positions in things like tobacco and beverage companies.
Okay. So things that people buy no matter what's going on.
No matter what's happening.
Yeah, kind of a recession.